Good evening, you guys. It is Sunday, the 7th of June, and gonna do a stock screener for you guys. This is S&P 500, specifically stocks. To let you guys know which stocks are at least worth looking at as far as the way my screening criteria goes. I will walk you through the process a little bit here. This is good for anybody who invests outside of TSP or even through the TSP mutual fund window. So a lot of you guys who watch my videos here are TSP group members, right? But this is not exclusive to those of you guys in my TSP group. So it's going to be a little more broad. I'm going to show you which sectors are especially probably most worth looking into as whether it be in the TSP mutual fund window. If you have a 401k account that you can invest in sector or industry funds as well. There are too many different 401k, 403b, whatever type of accounts out there that may or may not have that capability. So if you have the capability to invest more narrowly than stock index funds, this may be of interest to you, okay? Also, if you have a taxable brokerage account or a TBA, which we call a TBA, like a Schwab or E-Trade or Robinhood, whatever kind of account, that's a TBA. If you are able to invest in individual company stocks, this video might be for you as well on what might be worth looking at. I'm not going to tell you buy this or buy that. I'm just telling you what fits my own screener criteria. Basic screener criteria. I might go a little more narrow than that on my personal portfolio, but I'll just give you guys an idea where you might want to focus your attention to hopefully get better performance from your invested money. Okay, so let's start with how does my screen work? All right, first, we want to look at what's going to get us better performance than the S&P 500. Right now, the S&P 500 is expecting 15.5% earnings growth. At least that's what I have for it. I thought I had it in here, but do not. Okay, so given that though, all right, so you have what's called a Global Industry Classification System, or GICS. I call it GICS for short. Now, the more broad in nature it is, I would say the less greater the performance needs to be over that of the index to be possibly worth looking at. Generally, I'm using the screen as a go up about 5% for every level you go deeper. So for the sector list here, where it's the sectors, you got 11 sectors here, and you got ETFs here for each of those sectors that you can invest in if you have an IRA or, now these are ETFs, not mutual funds. So if you're looking specifically for mutual funds, which I only recommend messing with in a retirement account, I don't recommend doing mutual funds within a TBA. If you're going to be in a TBA, look at ETFs specifically. They trade intraday, and they trade just like stocks. You only get taxed on what you specifically actually sell. Mutual funds are a different animal when it comes to that. They actually get taxed whenever anybody in that same fund sells. Basically, it's like a community tax that gets paid in a way, to put it more simply. So even if you never sell your shares, guess what? You're still paying taxes on what everybody else does. So that's why I usually say don't mess with mutual funds unless you're in a retirement type of account, some kind of a tax advantaged account, perhaps. Okay, but generally, what we're going to do here is any sector that has at least 5% greater earnings performance expectation over the next year than the broader index, the S&P 500, we're going to look at those. There are only 4 of them here that meet that criteria, which is communication services, energy, technology, and materials. The rest of them are expected to underperform in earnings. So because they're expected to underperform in earnings, I'm expecting them to underperform in price performance as well. Okay, and we want to use the ETF effect to our advantage, not to our disadvantage. What I mean is you could have a company, let's just say, and I don't know, we might say financials. You might have a really good financial stock company in there, but if the broader financials group, we have 76 companies in that sector, and if your one stock has let's just say 100% earnings growth expected, but the rest of the sector is just basically a dog, there's not such a great chance that your stock's going to perform as well on price relative to earnings as it will if you're in a stronger group. Like communication services, it's the top one right now, but I don't really call it the top one, and I would have to get into that with the screener later on in this video. But it's at least, as far as what the raw data is telling me is concerned, it is the top one at the moment. There's more to it. I'll get into that point when I'll get more into the details of that when we get to that point though, okay? But we're only going to look at communication services, energy, tech, and materials, nothing else. Okay, so if you're looking to add a stock to your portfolio, look at these 4 specific areas, particularly if you're wanting to follow my screening process. again, you can do your own screens. You might have your own reasons for doing something different. Maybe you're a contrarian type of investor or whatever. I'm more of a momentum investor. I want what the earnings are telling me is going to happen. You know, if the price follows the earnings and the earnings are expected to do well, then and outperform the index, then I'm expecting the price to also outperform, and that's what I'm looking for personally. Okay, so given that, that's what we're working with. You can, I don't have the other, the percent of the market cap in here with each of these, but it at least shows how many companies are in each of these sectors. Got 23 total communication services companies, 21 energy, 72 tech sector companies, and 26 materials companies. So right there, we're already down to less than 150 stocks that we're even going to look at, possibly. And then we're going to narrow those down even more as we go. So, because like I say, if sector, I want to see at least 20% earnings growth. And then the industry group, which we'll get to afterward, I want to see at least 25% growth, because each of these sectors can break down into one or more industry groups. And then those industry groups can or may not break down further into industries, different industries. For industries, I want to see at least 30% earnings growth. And then sub-industry, I want to see at least 35% earnings growth. Now, as far as the individual companies are concerned, at the very least, I want to see at least 35% earnings growth, nothing less. And that's all I'm going to look at in the scope of this video. I might even go with it because it's a sub-industry and it's a group of stocks. You might want to say go up to like 40% as a minimum for your earnings expectation. So, but at the very least, we'll just say 35. And you guys can decide from there if something's a little bit in between 35 and 40 as an individual stock, which there will be some in here. Then you can decide whether it's do I want to touch them or not really want to touch them. That's your call to make. Okay. So that said, now you know the process that I'm working with. I'm going to show you, I'm going to break down each of these areas here. Let's start with the communication services sector. As you see there, we got two industry groups here, telecommunication services and media and entertainment. Now, I don't want to touch an industry group that doesn't have at least 25% earnings per share growth. So that's going to eliminate the telecommunication services group. That leaves us with media and entertainment. That one has 88 to almost 89% earnings growth expected. That is very strong. That is really good. But this is the one that I'm telling you is a little skewed by one particular company that had minus $44 per share earnings 3 quarters ago. I will get to them. They are actually in this screen. So you will see them. I've not looked into the details of has their price done what their earnings did, and is the price going to go back up or whatever. You guys can look more at that. I'm looking at more broad figures. So I didn't take the time to look at what their actual share price did when we get to it. Okay. Whatever the case, we got 25% minimum for industry group, and now we want to look for 30% minimum from the industry. Okay, so that's going to eliminate interactive media and services. That leaves us with media and entertainment as your industries that want to look at as far as individual stocks, or if you can find ETFs or mutual funds that are particular to these industries within that sector. You can do that too. If you don't really want to invest in an individual stock, maybe you're a little more risk averse, but you want some kind of more performance, but at least some a little more diversity, I guess, in a single stock. You can do that. The more narrow your focus is, the better your risk reward is going to be, though. You're greater. I mean, not necessarily better. You have a potential for much greater performance, but also a potential for greater lack of performance, to put it simply. All right. So now we know we want to look at media and entertainment specifically. We'll look at sub-industries, and we will weed out anything that is given that expecting less than 35%. This one I actually had to fix the formula on there because we went from negative earnings to positive, and it should be a positive result, not negative. That got fixed already, but I did this screenshot before I actually did that. So, and those 3 cable and satellite companies in there, that's the one that had the negative 44 earnings that really screwed up this whole number. So in reality, it's if they didn't have negative 44 earnings, probably would have been around plus 30 or so, trailing 12 as a group. So, I mean, we're still talking more than, that's still more than 50% earnings growth, even if they had flat earnings performance as a group. So still possibly on the strong side there, worth looking at here. So for that reason, we're going to look at these 3 cable and satellite companies, and we're going to weed out the interactive home entertainment because they're just not quite there. Again, I want to see at least 30% earnings growth. It's almost there, but not enough to really be worth looking at. So we're just going to look at cable and satellite and movies and entertainment. The four companies. And was that make sure. Yeah, that's okay. Yeah, I want to make sure my formulas are working correctly there. So they are. All right, so those we got 7 stocks in this sector that might interest you, but again, some of these individual companies might not meet the criteria, so it'll actually be less than 7, no more than 7, but probably less. And as you see here, only 3 of the companies actually meet the criteria: Live Nation Entertainment, EchoStar, and TKO Group Holdings. Now, EchoStar is the one that I was mentioning, if I remember right, that had the negative $44 earnings per share and 3 quarters ago. They're the cable and satellite company. So that could be a crapshoot there. I don't know. But again, you have to do your due diligence and research. Maybe you might have an interest in them, and maybe they might be a good buy. I'm not doing that research. I'm not looking at buying in this sector at the moment. So it's not really a concern for me. But these are the 3 specifically I would look at if you're looking to buy something in the communication services sector. All right. You see 2 movie and entertainment companies and 1 cable and satellite. Now, I don't recommend you worry too much about the price unless you have a smaller amount of cash on hand. Don't worry about how many shares you're buying. Even if you can only buy 1 share, it doesn't matter. How much money are you putting into play? That's what's important to you. If you only have $500 that you can put into play, then put $500 in. It doesn't matter if you get 1 share or 10 shares or 100 shares. What's that? What percent growth is that $500 going to get you over the next year? That's what you want to do. Don't think that share price, a lower share price is going to get you better performance potential. It will not. It depends on how diluted their shares, the company's shares actually are. I mean, you can have really concentrated shares and an astronomically high share price on a company that could actually be a real winner. Like SanDisk, we're going to talk about them in a little bit here. With their $1,500 plus share price right now. Or you could have a company with very low share price. These are all $100, $200 range stocks, which they are expected to at least perform well in earnings. But you'll have some others that have lower share prices that are not expected to perform so well. Do you really want to buy 1,000 shares of something just because it's got a low share price when your same money can get you better performance on something that you can only buy 1 or 2 shares of? Exactly. So don't worry about share price so much unless let's just say you only have a couple $100 or maybe not even $200 available to you, then maybe TKO Group out of this particular group won't be a good option for you, but maybe the other 2 will. On the other hand, if you're looking for dividends, then TKO Group is the only one of these 3 that will interest you, because Live Nation Entertainment and EchoStar do not pay dividends, as you see over here on the right side. Only TKO Group does. They pay right at the moment at 1.53% dividend yield. A little on the low side, not bad. Usually you want to look for somewhere in the 2 to 4% range. Generally, I usually expect to be somewhere in, actually more realistically, about 2, maybe 3% when you're first starting out. And then if they increase their dividend amount over time, then the shares you already own, the yield on those go up. And, as the price goes up on new shares, then your yield goes down, basically, right? So, if you're looking for specifically for dividends, you look over here at the right side. I don't want to keep hashing those out. I'm not going to keep talking about those, but I want you to be aware of what you might be wanting to take a look at here, okay? Looking at these same stocks, with their earnings now, they are ranked in order of how strong their growth expectation is. Live Nation obviously has the strongest growth expectation. They do have a couple of quarters of negative earnings performance expected in the 3 and 4 quarter out range, but they look good in the more near-term future. Next quarter on August 6th is when they're tentatively scheduled to announce again. And again in 4th quarter, they look good. So that might be good now. But something else here that might be a potential reason to look at them is, if they're expected to be negative, that's not necessarily a big deal. But is this negative a better negative than this one? Yes, it is. Not by much, but it is. But then the 4 quarter ahead one, it's 7 cents. It's negative 7 cents per share, but it's way, way better than the most recently reported quarter of negative $1.85. So that's another thing that bodes well. Something if you're looking for trend and like when this momentum stock might become a contrarian stock, like to sell or something, those are things you might want to look at. Are their earnings accelerating or decelerating? If they're decelerating down to 0 and starting to turn negative, then it might be, or expected to turn more flat. They might not be quite as much of an interest to you, perhaps, like TKO Group. If you look at the most recently reported quarter of $1.12, and their next one, the same quarter the following year is supposed to be $1.24 or anticipated to be. then it might not be quite as interesting to buy for you unless you're buying it specifically for the dividends or for the more near-term performance, price performance. But longer term, I wouldn't expect that one to perform maybe as strongly on price. But like I said, you will get dividends out of that one. Now, possibly a dividend increase. Probably there's actually a pretty good chance of a dividend increase. Speaking of, okay, the other thing here, when you do get to the other views, you're going to see some over here that are colored in green or I think red or peach or whatever. If they're green, it means they announced they increased their dividend amount since the last time I looked at them. And if they are red or peach or whatever, then that means they decreased or eliminated their dividend since the last time I looked. Okay, so in this case, TKO Group, they are not colored at all, so it means their dividend amount is the same as it was the last time I looked at them in the previous quarter. Let's move on to energy sector now. That is the XLE Spider ETF. If you guys want to invest in the broader energy sector, there's 21 companies in there. Now, there's only one industry group here, so really can't do much with that. But we can filter down the industries. Energy equipment and services, there's only 3 companies in there, and they're expecting minus 1% earnings performance, so absolutely not interested in that group. These are the oil, gas, and consumable fuels industry. And you see there are 4 sub-industries: integrated oil and gas, and then oil exploration and production, refining and marketing, and oil, gas, storage, and transportation. However, oil and gas storage and transportation, if we're looking for at least 35% earnings growth out of these groups, we're going to eliminate oil, gas, storage, and transportation. Now all we have left are these. We got 14 companies out of this list that we have to work with. You see, they all are expecting strong earnings growth. Looks really nice. So let's go ahead and look at those more individually now. But these are the ones you might want to look at if you want to look at a little more narrow. If you want to look at energy sector specifically, but a little more narrowly. Okay, we have a handful of companies here, perhaps a dozen, 5, 6, 7, 8, 9, 10. Yeah, right at a dozen companies that meet the screen. Phillips 66, Chevron, Marathon Petroleum, Occidental Petroleum, Valero, ExxonMobil, Texas Pacific Land Corporation, ConocoPhillips, Diamondback Energy, Devon Energy, EOG Resources, and APA Corporation. Okay, so you might notice over here on the left side, we have some that are colored, the stock symbols are colored in dark blue, like a royal navy blue type of color. And you also have Chevron specifically, that is a peach color on the company name. I will explain those. Okay, if you see dark blue on the ticker, that means they are in the top 100 in the S&P 500 market cap rank. So they are a large company. So as you see here, ExxonMobil is the largest of them at $621 billion market cap. Chevron is next at $373 billion, and ConocoPhillips at $142 billion. All right, so those are the 3 that would be higher ranked. And then Chevron specifically is also in the Dow Jones Industrial Average, and that is why you see their company name colored in peach. I do not care the least bit about the Dow Jones Industrial Average, but some of you guys do. So for that reason, I do color some of the DJI stocks for those of you guys who actually do care about that. All right. So this is your list that meet those sub-industry screens. Now, and you got a list of the stock prices here. These are just day-to-day price changes here, so I wouldn't worry too much about them. I would worry more about what their earnings per expectations are. Now, keep in mind also, this happened, all these prices changed a week before SpaceX did its IPO, is planning to do its IPO. Now, a lot of you guys might not understand that maybe you're just barely getting into stock investing, or maybe you have some investing experience but aren't aware of how, necessarily some of these little intricate details. Okay, when SpaceX IPOs next Friday, people are going to want to be buying shares of their stock. They're expecting it to be a big hit. Do I necessarily agree with them? That remains to be seen. I think they are a good long-term buy, but here's the problem. If let's say you have all of your money in your account already invested in other positions, and you want to buy SpaceX, I have no idea what the share price is going to be. I have an idea what their market cap is anticipated to be, or possibly, but it might even be about as little as half of what they're expecting. All I know is about 5% of their total shares are going to be available for public trading, and I don't know what that's going to translate to as far as how many total shares and what share price is going to get them to that market cap they're trying to get to, or thinking they're going to get to. All right, but whatever the case, when you sell shares, you have to wait for the funds to settle. It's just like let's say if you make a purchase with your debit card or check or something on your regular checking account. When you first go on I'd say with me on my Bank of America account, I might go on there and I might see that a particular transaction is processing. Okay, so I'll see it right away. The same day that I actually did the transaction that it's processing, but it doesn't actually post for at least 2 days after that, usually. And stock sales, the money from stock sales is the same way. They have to go through a clearinghouse first before the money can get cycled back into your account as settled funds that you can retrade with. Depending on your broker, you may or may not be able to trade unsettled funds. Maybe you have a margin balance to work with that you can trade with while waiting on that money to settle, but some people don't. So I'm going to throw this out here for you guys, right? This is for this reason, between Friday and probably Monday and Tuesday, you're going to probably see more sell side pressure on some of these stocks and all these other indexes because people are trying to free up money so they can have the cash available to buy shares of SpaceX when they IPO next Friday. They can't, let's say if they wait till Wednesday to sell, then the funds won't, they might not be settled by the time it's time to start buying SpaceX, and then it's too late. So they're going to start selling in advance while they have a good enough share price before everyone else starts selling. That's why Friday was probably especially bad. And then might see some more downside pressure again on Monday and Tuesday, perhaps. And, then maybe it might stabilize after all the hype with SpaceX is done. Not going to go into all the details with SpaceX IPO or how an IPO actually tends to happen on IPO day, but just know that short-term price behavior right now could be creating a really good buying opportunity for some of these stocks just because people are selling out of these positions in anticipation of buying SpaceX next week, okay? Now, out of these stocks here, we have 5 of them, actually all of these stocks in this group do pay a dividend. 5 of them increased their dividend since the last time I looked at them. So almost half of them have increased their dividend amount, which is good news. That increases the yield on any shares you might already own of these companies. And it also does help the dividend yield on shares that you don't already own. So like in Chevron's case, we got a 3.8% dividend yield. That's actually pretty good for just buying into new shares of a company that's actually a pretty decent dividend yield to be looking at. I would absolutely consider them if I'm looking specifically for dividend yield. Who else we got here? ConocoPhillips, I think at 282. EOG Resources at a little bit just under 3% as well. And then Phillips 66 at 2.77. I have owned Phillips 66 in the past and I still like them. So I think they're definitely at least, and they're the top ranked one here. As you can see here, they are expecting over 129% earnings growth over the next year. Chevron, Marathon, and Occidental are also expecting more than double earnings growth over the next year, which is very strong. And the rest of these companies are still well within, still all look good. APA, kind of borderline. As an individual stock, I might want to look for something with 40% or greater earnings per share growth, but they're right there. They're right below it. So they could be worth it. Again, I'm not going to say don't buy them because they could be a reasonable option for you personally. Just because I'm screening doesn't mean that they aren't going to be a good, they aren't worth looking at for your own portfolios. But these are the ones you would want to look at in the energy sector as a minimum, at the very least, and then figure out from there. Do any of these not look quite so good to you for whatever reason? You might have your own different reasons why you might like or not like them, whether it be the financial fundamentals of them or something else about them. Maybe they do business in certain countries that you don't like, or who knows? You'll have your own reasons, but these are just to help you out. And then you can filter down on your own to which one of these ones am I more interested in for which reasons happen to be your own. Let's look at the tech sector next, all right? So we've got 3 industry groups here: software and services, hardware and equipment, and semiconductors and semiconductor equipment. Now, software and services, they were kind of on the strong side. They were strong before, and that's where a lot of the AI is happening, but 13.65% earnings growth expected from that group over the next year is not good enough. That is not even as good as the S&P 500. I mean, it's too much risk, too much risk for not enough reward, basically. I want to see if I'm going to take more risk, I want to have a higher reward potential to go with it. And so software and services, let's get rid of them. Now we'll look only at hardware and equipment and semiconductors and semiconductor equipment. I have talked about hardware. I've talked glowingly in the past videos about SanDisk. I think even Micron. I had a member of the group actually say that they bought both SanDisk and Micron previously, earlier this year, because of past videos that I've done. And that person is extremely happy with the results. I think they said they're up 200% on their positions because of those videos that I did, right? Not going to say that that's what you can expect to get that kind of performance every time, but at least I have one really happy camper with what information I gave out. It makes it easier for you to narrow down what to look for. Okay, community now industries. Again, I'm looking for 30% or greater growth. So we're going to eliminate electronic equipment, and that leaves us with communications equipment, tech hardware, storage, and peripherals on the hardware side, and then semiconductors and semiconductor equipment on the semiconductor side. Now, looking here more narrowly, communications equipment is only at 31%. We want to see minimum of 35 for sub-industries. So we're going to eliminate that and also eliminate semiconductor materials and equipment. There are 5 of them in there. That leaves us with 9 hardware, storage, and peripheral companies and 14 semiconductor companies. So 23 total that will possibly meet this screen, and it'll be less than that, obviously, because not all the companies out of those 23 are going to be expecting the kind of earnings growth individually that we're looking for. As you see here, we got maybe about a dozen again. Look like 13-ish, 12 or 13 of them here. SanDisk, Micron, hey, those same 2 I just talked about, still right up there at the very top. Seagate, AMD, Western Digital, Microchip Technology, Broadcom, Intel, NVIDIA, Analog Devices, or ADI, for those of you guys who know much about them. We call it ADI because some of the hardware that they sell for computers. Texas Instruments, Owen Semiconductor Corporation, and Dell Technologies. All right, Dell is at the bottom of this list, but I'm going to tell you something about them here in a minute, but when I get to it, okay? But you see a good number of these, 10 of these companies are in the top 100 in the market cap rank with the S&P 500. Now, a lot of these got pretty good size haircuts here. A lot of these went into correction territory in a single day. SanDisk, Micron, AMD, Western Digital, looks like maybe Intel, and Owen Semiconductors all took 10% or greater losses in a single day on Friday. But that big cuts, big losses like that also means better chance there's a good buying opportunity in the immediate future for them, especially when their earnings growth expectations are all high. Okay, now some of these, again, looks like 4 of them do not pay dividends. SanDisk, AMD, looks like Broadcom, Intel, and Owen Semiconductor, if I have it right. I did not filter them down because you guys can figure it on your own. If dividends are important to you, you can figure out, you can eliminate the ones that don't on your own. You can do your own research on them. But out of the ones that do pay dividends, we have 3. Looks like Western Digital, and I think that's NVIDIA and Dell. All 3 of those had dividend increases since the last quarter. Now, they don't pay much of a dividend yield at all. None of them pay more than not even 1% dividend yield, which is pretty weak. But mind you, dividend yields are not always the most important when a lot of times companies are also buying back shares. And when they buy back shares, it actually increases the value of the shares that you already own. So even if they don't pay a dividend, that is something worth considering. And if they buy back the shares, they take the taxes, and basically you don't have taxes to pay because dividends, they actually do pay dividend. You do have taxes on dividends, but if they just buy up buy more shares, that increases the value of your own position. Well, if you haven't sold any shares, then the value of your position is also increased by just them selling shares, buying more shares of their own company. Just food for thought. So keep that in mind. If they don't pay a dividend, that's pay attention to how aggressive they are about buying back shares too, because that could help you with artificial value, if you will. Not necessarily artificial. You might still have the same public demand for them, but when there are fewer shares available, then it creates a higher share price naturally. And any shares you already own, that's a good thing. And looking at the earnings updates here for them, you see here SanDisk and Micron are way over. SanDisk is expecting almost 400% earnings growth over the next year. It is huge. Their last quarter update was massive compared to what they were expecting. And the forward estimates all went up a large amount too. It was huge. And, I'll let you figure out the rest of these. I will just talk about Dell so I can keep this video from being too much longer here. Dell, they are at the bottom of that list and technically not strong enough to be as an individual stock if I'm looking at 40% or greater growth, but at least in that 35 range. I just updated their earnings list last week, the end of May. And they were only expecting high $2 per share earnings on their last quarter, and they reported high 4s instead. They also were expecting high 2s, if I remember right, mid to high 2s throughout the next year for the earnings. And as you see there, all of their forward estimates are up over 4 now. So that actually bodes well for their price performance. If they just beat up on earnings expectations and raised their earnings expectations over the next year by that much, that recently, it's probably going to mean there's better chance you're going to see some short-term price performance potential there, okay? Don't know how they'll do over the long term compared to the rest of these companies, but short term, you might have a better chance at gains from them than some of these other companies here. We'll finish this up with materials sector. You see there's only one industry group, and that group breaks up into 4 different industries: chemicals, construction materials, containers and packaging, and metals and mining. Now, again, I want to see at least 30% earnings growth out of these groups, out of these industries, and 2 of them do not. That is the construction materials and containers and packaging, so we will eliminate them. That leaves these the chemicals and metals and mining industries, and from those, we can look at the sub-industries and eliminate any that don't have at least 35% earnings growth expected. And you see, actually, out of all that, that only leaves us on the chemical side with commodity chemicals, and on the metals and mining side with copper and steel. There's one gold company in there that got eliminated by that because they're just not enough expected from them to be to meet this screen requirement. So we only have 5 companies total that could possibly even meet the criteria at most. And all 5 of them actually do have a strong enough expectation to meet this screen. And you see here, you got 2 chemical and 3 metal mining companies: Dow Incorporated, Lyndon L. Basell, Steel Dynamics, Nucor, and Freeport-McMoRan. Okay, but something else to look at here. Lyndon L. Basell did decrease their dividend amount since I last looked at it. They still have a very, very respectable dividend yield. And considering the fact they are expecting earnings growth, I would not normally expect them to be decreasing a dividend amount with earnings growth expected to come in behind it. So why that went down, I don't know. It might not have even gone down much. I don't remember what the exact number. I didn't keep a record of how much each one changed by necessarily. So, but I do know it was lower than what it was before. Meanwhile, Steel Dynamics, they increased their dividend. Again, was it by, it could have just been by a penny or 2 for all I know, or it could have been by a little more. But whatever the case, Steel Dynamics, not even a 1% dividend yield. So it's, don't buy them. Don't expect much out of them for, at least for dividend performance, but at least they do pay a dividend. And if you're going to be buying more shares of them, then maybe at some point their dividend amount goes up. It could still be a good hold for you, perhaps. I don't know. Now, looking at these stocks with their earnings growth potential, Dow and Lyndon L. Basell are way over double earnings growth performance again. But I will say Dow is underwater with their earnings. 4 consecutive quarters of negative earnings performance. I don't personally like to see that. Normally, I won't touch a company personally that looks like that. I would eliminate them from my own portfolio. But again, that's my portfolio. If you have if you're more willing to invest in a stock that's underwater with its earnings, go for it. Don't think that you have to follow my strategy. Okay, you can have your own reasons for possibly liking this company. That doesn't have to relate to just because their historical earnings here are making them a little more questionable with what to expect looking forward. Doesn't mean that they're not a good buy. It just means I don't want to buy them personally. That's it. Okay, but all these companies here look like they all merit at least some attention, at least looking at them. Okay, so I know that was a lot to cover. I know maybe those of you guys wanted something a little more short to the point, but it is hard for me to actually just, here, look at this. I don't want to just give you stock screens and then have you like, okay, well, why do these meet your screen? That's not fair to people who just because I say these, whatever, doesn't mean that they're a good option for you, right? I'm not just going to just give you, hey, look at these, look at that, look at that. I'm not going to be a used car salesman. I'm going to explain to you my process. Why am I personally interested possibly in any of these stocks that were presented here? It doesn't mean that I'm going to buy any of them, but if I'm going to buy at all, those are the ones specifically that I would be looking at for my portfolio. And I'm not a used car salesman. I'm not going to try to be one. I don't make a damn dime off of anything I'm telling you here. You guys are the ones who can benefit. You're not buying anything from me here, okay? So if you guys did take the time to watch all of this and get a really good understanding of not just what meant my screens, but also why they fit my screening criteria, then even better for you, okay? You'll have a better understanding, might help you with your own screening process. If you want to do your own process without my videos in the future, so be it. But it's, this is meant to be educational for people who are just getting into stocks as well, who might want to learn how to figure out what stocks might be meriting attention and which ones, hey, might not want to look at them because Scott's not interested in them or something. But everyone has their own strategy or needs, so just keep it at that, right? Whatever the case, I'm going to end this one. Appreciate you guys taking the time to watch. know it was a little lengthy, but it is what it is. Let me know, if you guys ended up having any interest in anything in particular that you come across on this video, and over the coming months or quarters, whatever. Let me know how it all pans out for you, how things worked out, or maybe get some feedback. Put some comments on there. Why are you not interested in anything that you saw mentioned here? I welcome that. Any kind of discussion that could be good for other people also to look at, because my posts are always public, so you don't even have to be on my friends list to see this. Any random person could see your comment and possibly be influenced by it to, hey, maybe this is a good buy, or maybe it isn't, based on something you say too. All right, that's all I got. Appreciate you guys watching, and thanks for taking all that time to watch all this. We'll see you guys end of the quarter, end of June. Okay, see you guys.